Okay, in this session we're going to discuss an alternate way to execute a single-in scale-out trade with options. I'm assuming that you know something already about options, and if you don't know what a put or a call is or a risk graph, etc., I'd suggest reading up on the topic of options. Check out a website like optionseducation.org or some other resource before you watch the rest of this video, because it's really important that you learn the basics about options. I don't want to waste your time covering off a bunch of simple stuff that you may know already. And when it comes to option strategies, there's a lot of them out there. What we're really going to be focusing on here are covered calls and put strategies. Covered calls and covered puts. But before we get started, there's just a few things that I wanted to mention about options. Maybe you've heard that most options expire worthless. This is true. Large institutions sell options against the stock in their inventory to collect option premiums. They view purchasing options as a sucker's bet for the retail investor. Sometimes they will buy options for hedging purposes, but primarily they're always sellers. With this concept in mind, as the option expiration date approaches, things get interesting. There's a lot of volatility as institutions look at the strike prices of all the options that they've written and sold, and they have to determine where the underlying stock ideally should be trading at so that they can collect the maximum amount of option premium at expiration. Once this level has been determined, then the institution will attempt to manipulate the stock price to their desired level hours, minutes, even seconds before option expiration. This point where the institution moves the stock to is called maximum option pain. Maximum option pain is a theoretical point where the maximum amount of option buyers will lose money because the option that they purchase expires worthless. Now, the cost of buying or selling a stock to artificially manipulate it to a certain price on the part of the institution, the cost of doing that is nothing compared to the money collected from having all these options expire worthless. Is it sound unethical? Of course it is, and it happens all the time. Option strategies can be very complicated. There's all kinds of different strategies. There's the Greeks, the volatility, implied volatility. Many factors have to be considered, but in this session we're going to keep it real simple. I mentioned that institutions are primarily sellers of options, and guess what we're going to do? We're going to be doing the same thing. As you'll see, the strategy is conservative compared to the single-in scale-out strategy that I've showed you before. It's a little bit more conservative than that, and I'll show you why here in a minute, but it can further reduce the risk involved in outright long or short positions. So if we want to sell options, when should we do that? What strike prices are we going to use? How does this relate to the single-in scale-out method? We're going to use the same rules as the single-in scale-out method with one important difference. When you enter a new position with 3 lots, you're going to sell an option. So for an example, if you're going to buy 300 shares, you're going to sell a call. If you're going to sell 300 shares, you're going to sell a put. Notice we're always selling options, but depending on the direction of our trade, it's either going to be a call or a put. Okay, that's fine, but what strike price are we looking for here? What strike price do we want to use to sell our options at? What we're going to be looking at is the second target in the single-in scale-out method. We're going to look at the strike price just beyond that second target. So we're going to sell an option at the strike price just beyond the second target. What are we going to do with the third lot? What we're doing with the third lot is creating a covered call or covered put position. Now, if you're familiar with this strategy, you know already that your profit on the third lot will be limited to the strike price of the option that we're selling. Unfortunately, for us gamblers out there, remember the lottery ticket trade? This eliminates the lottery ticket effect on the third lot. However, there are clear advantages to doing this, and we'll see what they are here in a minute. So, in regard to stops, we're going to use the same rules dictated by the single in scale out method for our stops as well. The only thing that we're really going to do different here is we're going to be buying back the option at the same time that we liquidate our regular positions. So under most circumstances, when you buy back the option, the price will be less than what you sold it for. So you sold it for a higher price, you buy it back at a lower price. Under most circumstances, even when the trade goes against you, you're going to make money on that option trade. Now the profit from that trade can be used to offset any losses on your overall position if the trade goes against you, and that's good. It reduces our risk, and this is the worst case scenario. So that's a benefit of doing this. The best case scenario is if the trade actually works and goes in the direction that we want it to, and after hitting our second target, we're not just going to use a 3-bar trailing stop anymore. We're simply going to hold the position until option expiration. At that point, we liquidate our regular position and let the option that we sold expire worthless. Now, if the option is in the money at expiration, as mentioned, our profit on the third lot will be limited to the strike price of the option, and anything beyond that strike price is going to be going to that option buyer. Now, this might sound complicated. If you've never heard about this before, why should we bother? Well, you don't have to. Don't worry about it. You can keep doing what you're doing, but here is the primary advantage of doing this versus outright positions. The benefit of what I call the covered third, or covered third lot, whatever you want to call it, the covered third, your initial risk is reduced. With a regular single in scale out trade, you would calculate your initial risk, multiply times 3, and that was it. That was your total risk. Now, if you do the same calculation, you can subtract the premium of the option that you sell from your total risk. That's good. So as the slide points out here, IRX3, initial risk times 3, subtract the premium. That's the benefit. The trade-off is for the traders that like that lottery ticket trade. If there's a significant move in the right direction of the trade, the profit on the third lot will be limited by the strike price of the options. So this strategy is for the more conservative trader. Okay, enough theory. Let's have a look at some charts and look at an example here. All right, here's a recent example of PPL Corp. It looks like a bullish 38 setup here on this angle. And I'm looking to buy the high of the low bar. I've got my single in scale out lines all set up here. So this is going to be my entry point. Here's my initial stop on the low, just below the low here. So I know what my risk is, times 3. That's my initial risk. And I've got my first and my second targets. And then remember, if we're going to sell an option, where do we sell it? What strike price? We look for the strike price that's just beyond the second target. So our second target is 35.55. And then we have to look at the strikes of PPL. The next strike up from 35.55 is going to be 36. So I've got this line here to show you where the strike is. So what you want to do is if the market goes up and we get filled, we're going to be buying 3 lots here and then selling a 36 call here. So let's go ahead and see what that looks like. All right, so we've added 1 bar of data here. We're buying 300 here at 34.84, and we're selling 136 call. And this is once again the first strike that's beyond 35.55, the second target. So all our orders would have been filled there. If the market goes straight down and stops us out here, we're going to buy back that 36 call, and it's going to be less than what you're selling it for right now, because it's gone in this direction. There's time decay, there's delta, etc., that have an impact on this. So chances are that that option, when you buy it back, it's going to be a better deal. And then that profit that you make on that can be used against your 3-lot loss if it went straight against you here. Let's add some bars and see what happens next. All right, so here we have hit our first and second target, a big up day here, closing on the high. And so we sell our first lot here. We'd be still long 200. We want to move the stop up to here. If we had not hit the second target, if we just hit the first target and it would have went down to here, we would have sold the remaining 200 shares and bought back the 36 call. But it didn't do that. It went up and hit the second target. That means we move our stop to entry here at 34.83, and we're just going to leave that stop there. And hopefully the market will continue higher so that we can max out our profit on the range from the entry point to the strike price here. That's the maximum profit that we can get out of this third lot. So let's see what happens next here. Well, let's add another bar. Okay, so there you have it. This is our last slide. We can see that the market continues to move higher. We're going into the money with our position here. The person that bought the 36 strike from us is pretty happy about this, because that option could be worth more than what he bought it for, he or she. And so what do we do at this point? We're just going to sit on our hands and wait for option expiration on this. You can do what you want. If it keeps on moving higher, you can leg out. In other words, you can buy back the option at some point and keep the underlying position of stock, or vice versa. There's all kinds of things you can do with that overall position, but to keep things simple out of the gate, what I'd suggest is you just hold it to option expiration. It could end up being not as sweet. It could pull back a little bit here and expire maybe at our second target, for an example. You're still going to have an overall profitable position. However, like I said, there's all kinds of things that you can do at this point, but I'm just going to leave my stop at the entry point. And if it does turn around and go straight against us and it gets down to here, I am going to liquidate the last 100 shares, and I'm going to buy back the 36 call. Once again, we're still going to be profitable if that happens. But to keep things objective here and keep the rules really simple, I'm just going to suggest to leave the position on until expiration. All right, so let's just review what we've covered off here today. The single in scale out strategy, we know how to do that, but we're going to add another dimension. We're going to be selling an option. It doesn't matter if you're long or short, we're going to be selling. The single in scale out methodology, we're going to keep doing that. The only difference is we're going to be selling an option. If you're long, you're going to be selling a call. If you're short, you're going to be selling a put. What strike price are we going to use? We're going to look for the first strike beyond the second target, whether it's long or short. And how do we liquidate our positions? Well, we know how to move our stop up as the trade goes in our favor based on the single and scale out rules. All the rules remain the same. The only difference is if you get stopped out on the underlying position, you're going to buy back your option. And if you hit the first and the second target and it keeps going, just wait until option expiration before you liquidate, if it doesn't come back and hit your stop at entry. So liquidate the covered third at entry or at options expiration. Like I mentioned, there's a few other things that you can do there based on your personal preference, but these are my rules. So that's it for options. There's a lot of different things that you can do with options. I just wanted to show you one of the ways that we can reduce risk with options. A lot of people think that options increase your risk, but they were designed to reduce risk. And this is a good example of how to use options to reduce your risk versus outright long or short positions. So we have one session left in the Apprentice Level 2 course of the Geometric Trading course. And in our final session, you're going to learn how to measure the unmeasurable, to make tangible the intangible, to quantify the unquantifiable. Apprentice, this is your final step before you enter the realms of master traders.